Hello friends, good afternoon, greetings to all of you. I hope you all are doing pretty well in your respective lives. So here I, Kunal Nagpal, once again welcome you all to the refreshing economic session. Today we are going to discuss three basic news highlights. And these are very strong and really impactful news highlights. Firstly, the international organization, that is the IMF, calls for deep reforms because of the gradually intensifying global slowdown. We are all aware of the lot of unforeseeable factors which are existing in the global economic scenario because of the gradually intensifying Ukraine-Russia war. And we don't know that to which level it may go in the near future, though a lot of efforts are being made holistically to slow down and neutralize this ongoing crisis, but still there is a lot of turmoil. So this actually calls for deep reforms, and that's what we are going to discuss, that what all reforms the IMF is suggesting. Secondly, we are also going to discuss the basic modifications done by the Monetary Policy Committee in order to curb inflation. Though we have been performing quite better in this particular aspect, but because of the gradually intensifying geopolitical crisis, we have to be more proactive. So the RBI governor Shri Shaktikant Das has announced that the repo rate has slightly increased by a smaller 35 basis points as the fight against inflation continues amid growth woes. Yesterday we had discussed that the World Bank has revised its projection for India's GDP from 6.5% to 6.9%. So this is actually encouraging. But in order to make sure that inflation scenario and the GDP scenario go hand in hand, that is minimum inflation and maximum GDP. In order to attain this particular aspect, both sides have to be kept balanced for a stable economy to sustain in the long run. Moreover, we are also going to discuss the key perspectives by the renowned economist Mr. Rai Chaudhary of the BNP firm, and he very confidently states that India is a stable island in a stormy sea. He shares his very valuable insights. So let's begin with today's session. So first, a news highlight is the global slowdown, and the International Monetary Fund calls for deep reforms. The IMF yesterday pitched for deeper structural reforms and orderly deleveraging to mitigate the long-term effects of the impending global slowdown. In a detailed presentation on the world economy at the ongoing G20 Sherpa meeting in Udaipur, seen by the Economic Times, the IMF cautioned that the high-frequency indicators point to a weakening global growth momentum in the fourth quarter and sought measures to support the growth. The multilateral lender basically called for tightening the fiscal policy to address elevated debt levels and surging inflation. It stressed on the need for orderly deleveraging and sound debt restructuring frameworks to mitigate the risks, while flagging the elevating risk of high sovereign debt. Public and private debt overhang will basically require deleveraging, it said. Tighten the fiscal policy to address the elevated debt, and where inflation is elevated, to avoid working against the monetary policy. The presentation highlighted adding that the fight against inflation needs to continue and where needed, the countries should use macroprudential policies to avoid the risk from materializing. I repeat the modifications and the advice suggested by them. Tighten the fiscal policy to address the elevated debt, and where inflation is elevated, to avoid working against the monetary policy. The IMF has projected the Indian economy to grow by 6.8% in the current fiscal, that is the financial year 2023, and 6.1% in the next fiscal year, that is 2024. Whereas the World Bank had projected it to be 6.9%. The world economic growth is expected to slow to 3.2% in 2022 and 2.7% in 2023. So this is actually quite encouraging, that keeping the world economic growth, that is considering the world economic growth to actually slow down from 3.2% to 2.7% in 2023. The Indian GDP scenario is actually expected to increase, or is actually expected to get favorable from 6.5% to 6.8% as per the IMF projections. Forecasts imply significant medium-term losses for all world regions, particularly among the emerging market and developing economies, it said, while pointing out that the downside risks to the outlook were prevalent. China, according to the presentation, was witnessing stalled recovery in mobility and supply chains. Its economic growth is basically forecast to slow to 3.2% in 2022 from 8.1% in 2021. That's a rapid fall, actually. While the transport costs are easing, indicators of new export orders point to weakness. I repeat, while the transport costs are easing, indicators of new export orders point to weakness. It said, while observing that the trade-related uncertainty was spiking and calling for supporting growth in diversified global trade. The number of trade restrictions were on the rise, especially in the high-tech and energy sectors, the presentation pointed out. The IMF suggested targeting temporary measures to support the most vulnerable in view of the slowing global economy and high inflation. I repeat, the IMF suggested targeted temporary measures to support the most vulnerable in view of the slowing global economy and high inflation. It stressed on urgently implementing and broadening the G20 common framework and supporting growth in diversified global trade. The multilateral body also emphasized on the need to strengthen the global cooperation to mitigate the fragmentation risks. Next, we discuss the key highlights given by the RBI Governor Shri Shaktikanta Das to raise the repo rate by a smaller 35 basis points as the fight against inflation continues amid growth woes. The Reserve Bank of India led rate-setting panel on Wednesday, that is today, raised the country's policy rate by a modest 35 basis points in its last policy review of the calendar year, as the fight against inflation is not over yet, while the central bank will also have to fuel the country's economic output. The 6-member Monetary Policy Committee, with 5-1 majority, increased the repo rate, or the key rate at which the RBI lends the short-term funds to the commercial banks, to 6.25% from 5.9%. With this hike, the RBI has broken the 50 basis point hike trend that it opted for in each of the last 3 policy meetings. The key rate has now been raised by 225, that is 190 plus 35 BPS since May by the panel. The panel also decided to remain focused on withdrawal of accommodative stance. The RBI governor and MPC's chair Shaktikant Das said while the headline inflation may ease through the rest of the year and in the first quarter of the next fiscal year, it is expected to rule above the target. The medium-term inflation outlook is exposed to heightened uncertainties from the geopolitical tensions, financial market volatility, and the rising incidence of weather-related disruptions. I repeat, the medium-term inflation outlook is exposed to heightened uncertainties from the geopolitical tensions, that is the ongoing and gradually intensifying Ukraine-Russia war accompanied with the supply chain disruptions, financial market volatility, and the rising incidence of weather-related disruptions. Growth prospects across the world are dampening. The financial markets remain nervous and are characterized by high volatility and price swings, he said. On balance, the Monetary Policy Committee, that is the MPC, was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break core inflation persistence, and contain second-round effects. These actions will strengthen the monetary term growth prospects of the Indian economy, the governor said. Meanwhile, the more modest RBI rate hike also coincides with indications that the Federal Reserve will shift to the smaller rate increases at its policy meeting this month, as the US Monetary Authority too have to perk up growth while it probably has done a lot with 375 basis points of rate hikes to control inflation. While talking about the rate hikes, RBI Deputy Governor Mr. Michael Patra indicated that the 50 basis points consecutive hikes are over. That's a great news. We have moderated the size of the policy rate increase. It's the fundamental guidance we are giving to the market. If things pan out as we have projected, the 50 basis points consecutive hikes are over. But we cannot take our shoe off the brake because inflation is still averaging 5 to 5.4% next year, that is 2023. We must guide it to a place where it remains stable at those ranges and then move on to 4%. Till then, we must be on our toes, said Mr. Patra. The RBI policy announcement was broadly in line with our expectations, with a 35 basis points rate hike and no change in stance. That said, the statement was slightly more hawkish than perhaps expected by the markets, with no indication that the central bank is coming to the end of its rate hiking cycle for now, said Ms. Sakshi Gupta, principal economist at HDFC Bank. Indicating that the rate cycle is not over yet, she said, the reiteration of the fact that growth continues to be resilient while there are upside risks to inflation suggests the central bank's resolve to not let up its fight against inflation continues. This, at the margin, could provide a soft support for the rupee, especially ahead of the Fed meeting next week. We continue to expect another rate hike in the February policy of 25 basis points. So this will be a slightly lower increase from 35 to 25. So while inflation, which is of the key factors taken into consideration by the RBI while deciding the monetary policy, moderated in October to a 3-month low, it nonetheless remained above RBI's tolerance band of 2 to 6% for the 10th consecutive month. The 35 basis points hike is basically as per the market expectations. The positive is RBI has broken the 50 basis points rate hike trend as growth headwinds intensify amid easing inflation pain. That's really a great relief. Until the Reserve Bank of India is not completely sure of inflation's downward trend, it may opt for a smaller rate increases as it has to also focus on growth amid bets of easing inflation pressure, said Ms. Anu Agarwal, Head Corporate Banking, Kotak Mahindra Bank. Earlier, Ms. Rajni Sinha, Chief Economist at CareEdge, had said the overall moderation in the rate hike is on expected lines, with CPI inflation likely to moderate further, supported by the base effect and the base relief provided by moderating global commodity prices. RBI could take a breather. However, core inflation and household inflationary expectations still remain high. Hence, the central bank would remain vigilant on the inflation front. I repeat, the core inflation and household inflationary expectations still remain high. Hence, the central bank, that is the RBI, would remain vigilant on the inflation front. Hence, we need to be very proactive. As the central banks across the globe are perhaps preparing for a potential low inflation regime, the global growth slowdown has emerged as a new pain point for them to act on the policies. India's economic growth for July to September quarter slowed to 6.3% from 8.4% a year earlier when there was no geopolitical crisis, and 13.5% in the previous quarter, owing to the slower growth of the manufacturing and mining sectors. Though yesterday we had discussed that now the handsets manufacturing are taking a peak increase and rapid progress, and the services industries are also observing a very favorable trend in the Indian economy. The moderate pace of growth has increased RBI's concern, and it largely shifted the focus from inflation to growth. RBI commentary and announcement is mostly in line with street expectations, and thus we don't see any material impact on the economy from RBI rate hike decision. Inflation is basically expected to be around 5% in the quarter one of the financial year 2024 and 5.4% in the quarter two of the financial year 2024. Thus, the repo rate is expected to peak from 6.7% for this rate hike cycle. The government capex has slowed down in the second quarter, which is a bit negative. However, since we are entering into a pre-election year, we can see that reversing over the next 2 quarters, said Mr. Anil Rego, founder and fund manager at Right Horizons, SEBI registered portfolio management service provider. In addition, the impact of the past rate hikes and liquidity tightening measures have yet to be seen. Thus, going overboard with the monetary policy could hurt the growth recovery. But we need to be really very optimistic. That's the need of the hour. Hence, the RBI governor says the European regulators need to trust India's credibility and strength. Going forward, we are also going to discuss the basic insightful session, the question answer session with Mr. Rai Chaudhary, who leads the company BNP, and he says India is a stable island in a stormy sea. And we have been seeing from last few days in our sessions that India's performance is actually beyond expectations as it is being appreciated worldwide. So let's go forward. The Indian markets could start to lag its Asian peers once North Asian region starts to revive, said Mr. Manishi Rai Chaudhary, head of the Asia Pacific Equity Research and Asian Equity Strategist at BNP Paribas. In an interview with Mr. Ankit Doshi, Rai Chaudhary shared his investment themes while highlighting the strategy of the capital preservation. The first question put to this great economist is, what is the view on India vis-a-vis other Asian markets for the coming year 2023? To which he replies, India's outperformance this year arises to a large extent because of the North Asian region getting pulled down by the twin forces of developed market demand retrenchment, which we are still in the midst of it. The Indian region and the overall economy and some of the pockets of South Asia underperformed rather than its performance of the almost 16 months now. We think that for now, these outperformances are likely to sustain. India would only begin to underperform when North Asia revives. The Chinese authorities are gradually beginning to get out of the restricted policies like COVID-0. This could lead to the outperformance by Chinese economy as well. But for now, we are sticking to our overweight stance on India because it is a stable island in a stormy sea. How nice it feels to read this line that India is a stable island in a stormy sea. Hence, we are putting an overweight stance on the Indian economy as a whole. Next question put to this great pioneer is, how much more upside do you see in the market next year? To which he answers, the first half of the year is still going to be very difficult, very tough for the emerging markets. We are not yet out of the inflationary pressures in the developed markets. We are living in a world where the quantitative tightening is now in full swing. Compared to the 2018 episode of quantitative tightening, this is going to be much more severe. The pressure on the Asian currencies is unlikely to abate anytime soon. When you put all this together, this may be the first or the second quarter of the next year. The pressure on the Asian emerging markets would likely to continue. So the recovery, if any, will possibly be only in the second half of the next year. That is, July to December would be the favorable period of the fiscal year 2023. Next question put to him is, what is the possibility of a severe recession in the West and how will it impact India? To which he answers, Europe is actually already in a recession this quarter and the next. The only saving grace there is if the rate hikes do get capped at 5.25% and the Fed realizes that they are in the process of triggering a recession, they will possibly stop there. And we would end up having a relatively shallow recession compared to what we have been seeing in the last 3 occasions when the recession lasted for about 16 to 18 months. There is actually no evidence anywhere that the emerging markets are protected during a DM recession, that is a developed market recession. But this time there is one slight difference. The emerging markets have already reacted or have proactively been dragged down. It does clearly seem that the next round of big drawdown could be in the developed markets rather than in the emerging markets, which would possibly bottom out earlier than the developed markets. Hence, the proactive approach is very, very important. Now, the next question put to this great pioneer, Mr. Rai Chaudhary, is what have you been advertising and advising to the institutional investors? He replies, our advice to the institutional investors in Asia can be summarized in two words, that is capital preservation. Being overweight on India is part of that strategy. We are concentrated on certain pockets which have a growth story attached to them. The private sector banks and private insurance is one large pocket we play. Similarly, the four-wheelers are growing faster rather than the two-wheelers. We have exposure to both the conglomerate and the standalone play in telecom. We still do like some of the frontline large cap IT service companies despite the concern that their order flow would decline. So, dear friends, that's all for today, and I believe that this insightful session would help you to draw very, very useful points, and this will this will bring a very considerable impact on your overall knowledge base regarding the Indian economy, which is basically outperforming its peers in this current scenario of the global slowdown. And as has been quoted by the great economist, India is actually a stable island in the stormy sea. I hope you would be able to comprehend this particular statement in a very, very effective manner. Thank you so much. And I hope to see you next time. Till then, take good care of yourselves. Namaskar. Jai Hind.